We appreciate everybody coming today. And, the way this works is Carl has some stuff to share with us, but then it'll probably go about 15 minutes or 20 minutes or so. Does that sound about right, Carl? And about what he's seeing and how it relates. And then we'll have an open discussion so that everybody can kind of talk about their experience and share and so forth. So this will be hopefully a very collaborative thing, not just being talked at. So hopefully we can all have a chance to contribute in the discussion. So that's kind of the way we do this. I guess, Carl, any other key points you want to add to that before we get started?
Yeah, I think that's the high level of what we're going to do today. We're a couple after, I guess we wait a minute or two longer, get a couple more people in, and then we can kick off, do a couple introductions, and still have plenty of time for discussion as we get into the meeting as well. So, yeah, we do these once a month. And on Thursday afternoons, we do different topics, different issues of strategy, growth, opportunities. So we usually have some very good discussions.
I think a lot of today's conversation is going to be about some things that we see. Some of us are feeling in a significant way, and there's more of that to come, especially depending on where you are in the world. And we'll talk about what kind of things you ought to think about. These are things that probably should be affecting the strategy process. We've gone for a long time where strategy, when you start looking at SWOT analysis and things like that, people fill out the form and they don't spend a lot of mental energy on it. Well, there's a lot of things changing now that probably change that equation. And we have to spend a lot of time looking at opportunities and threats and looking at what we need to do, what we need to be better at. So this will definitely influence how people have to operate going forward.
I agree. Yeah.
Why don't we get started, Carl? I'll let you lead us off, and then I'll introduce you.
Very good. Very good. Steve Thornton is our moderator today. Steve is a profit and growth strategist. He is with Apex Management Partners here in Houston, Texas. Steve?
Okay, and Carl Meyer is going to be our speaker, and he's the author of Surfing Economic Chaos and relative expert in all these matters around geopolitical change and how that's going to influence the strategies in your business, and then the strategy you ought to think about deploying. So, Carl, I appreciate your book and the launch of that. It's coming in 30 days as well, right? Or less than 30 days.
Yeah, we have 4 weeks from today. Surfing Economic Chaos is the title of the book. We're going to have a virtual launch party. Be some fun door prizes, discussion, probably some trivia questions as well. Surfing Economic Chaos is talking about moving from the era of globalization that we've been in for the past 70 years and moving to a post-globalized economy and political world. We're in the middle of that transition right now, and that's shaking up all sorts of things in our environment, in our everyday life, and in the big picture of the world. These changes are driven by demographics and policies of trade and military. These policies and this demographic shift are going to have implications for the next couple of decades in terms of international relations, global trade, and just how the world works. For the United States, we're going to see shortages of labor as a persistent trend. Inflation is going to be consistently higher than we've seen it for decades. capital is going to be more constrained and higher priced. That's interest rates will be higher. And the supply chains that we're used to, these long, complex supply chains, are going to shorten dramatically. And manufacturing will be coming back to the US as a continued trend. All these changes present opportunities for entrepreneurs that are willing to change their outlook and their perspective. Let's talk about demographics. Demographics are about people. People are how things happen throughout our society, throughout our world. In a pre-industrial world, every country in 1750 and earlier, the demographics were very similar. You have lots of young people, and as you go each decade older, there's fewer and fewer people in each of those age groups. However, when the Industrial Revolution began to transform the world, first in Britain, then other countries in Europe, Japan, and eventually spread throughout the world, as you industrialize, you also urbanize your population. Urbanization changes you from a farming environment where you want to have lots of kids because they're free labor to an environment where you're living typically in a multi-family environment. Kids are expensive and you're likely to have one or two of them. As we move through life at different stages, we all behave differently. When we're under 20, we're typically students. As we move from 25 to 45, we have kids and houses and bigger houses, cars, furniture. We're consumers. We are at the peak of our consumption period. As we move into the age range from roughly 45 to 65, our earning power goes up, we save more money, and we prepare for retirement. After 65, we work less, we begin to spend down our savings, and we enter a new phase of life. All these things together, we put these together, and now demographics transform the way we see the world. What does a pre-industrial population look like? The way I break it down is I've got 20-year bands for comparability between the age of 5 and 24, 25 to 44, which we call consumers, 45 to 64 are producers in the green band, and then retirees in the orange. And then we add in a 0 to 4 year, the under 5 age group, as a proxy for the reproduction rate. So this is what a pre-industrial population looks like. So it's a very balanced type of situation. And as you begin to industrialize, you have lots of people in the consumer, the yellow age group, to buy your products, and a reasonable amount of people in the green age group who are able to produce and save, create capital. So that's a good situation for growth. Now let's look at the world in 2000. These are the 38 countries that together represent over 3/4 of the world GDP. These countries together also account for over 3/4 of the products traded in the world. And we can see that they've begun to change from the traditional pre-industrial demographic. We've seen the under 5 age group, their reproductive rate has declined significantly. They were almost 15% of the population, now about 8%. There's fewer students in the gray bar than there's consumers. So we're beginning to see some changes. But from an economic growth point of view, from a trade point of view, this is very good. There's more consumers than producers. The yellow bar is bigger than the green bar. So people are excited about exporting because they know there are other countries that are willing to import their products. So this is The last 20 years has been an excellent place for the world to trade. So let's see, as we move to 2020, basically the current period, we see that a lot has changed. The birth rates dropped a little bit. Students are still lower than the consumption age group. So we're going to see continued decline in the population there. The green bar is almost as big as the yellow bar. That means that there's fewer countries that need to import goods. If the green bar is about as big as your yellow bar, you're able to produce more than you're likely to be able to consume. Your growth rate is going to feel pressure. It's going to go down because of that changing demographics. And we've got more retirees. So that's going to put pressure on the system to have higher taxes to support those retirees. So we look at this and we say, if you could see the economic future, what would you do differently? That's an important question because we can now see the economic future. We know how many 20-somethings there are right now. So we know in 10 years how many 30-somethings there'll be. And the number of 30-somethings now will be 40-somethings. So we can see what's going to happen in the future because on a total, we can understand how groups behave, how much they consume, how much they save, how much they produce. So this helps us look forward into the future. And as we look forward into the future, there's going to be winners and there's going to be losers. Let's look at a little more in depth at some of these groups and some specific countries and see who the winners and losers are going to be from a demographic point of view. So now if we go back to the 2020, basically our current period, and we look at that same 38 countries, but we subtract off 3 countries, the US, Canada, and Mexico, that NAFTA group. And what we find is that there's even more pressure on the producer to consumer ratio. That means that these countries are going to be in aggregate less interested in importing goods. That makes for defensive pressure against trade, against exports. The retiree ratio is going up. So we've got some concerns with what's going on with that group as a whole. But now let's look at a particular country. Let's look at Turkey. Well, we see they've still got more consumers than they have producers, which is good. They're likely to still have the ability to grow with their internal consumption to drive their growth, maybe not as fast as they could have earlier in their demographic cycle. But they're actually one of the stronger demographics in the European space. Now let's look at France. France is more straight up and down. They've got a higher ratio of retirees that they're going to have to support. Their producers have now outstripped their consumers, so that's going to be tough on growth for them. But from a good news point of view, their students, the gray bar is about the same as the yellow bar. So looking into the future, they're still going to have some fairly strong consumption. So if these are the winners in particularly the European space, what do some of the not so good situations look like? Well, let's move next door from France to Germany. As we look at the green, yellow, and gray bar, what we see is basically it's the beginnings of an exponential decline in population. We're seeing the aging out of the system. So we've got population in the 45 to 64-year-olds. That's now the yellow group is significantly smaller. The band below them is significantly smaller. And the under 5-year-olds, in a pre-industrial setting, that was about 15%. Now it's under 5%. Germany, from a demographic point of view, has got some really significant challenges. Germany has benefited greatly from the globalization that we've had over the last 70 years. It's not at all clear that they're going to be able to maintain that as we head into a post-globalization era. Now let's look at Japan. In the mid-90s, Japan began to feel the impact pretty significantly of the aging population. And as we look at it here, we can see that exponential decline, that same percentage change down each generation. So their population is collapsing. They're working hard to change policies to make it stop, to level off and hopefully return to growth. But even if they do find a way to level off, they're going to level off at a much smaller population than they were at, well, in the generation that's now over 65 or even over 45. So Japan's got some very significant challenges from the demographic point of view. Now, in the book, we talk about a broader range of impacts besides demographics. So we do look at each of these countries and the world as a whole in a different way, more broadly than just the demographics. But for today, we're focusing on the demographics. Now let's look at North America, a little closer to home for all of us. So NAFTA, with Mexico, Canada, the US, is shaped completely differently. This hierarchy is shaped completely differently from Japan or Germany. We've got more students than we have consumers, than we have producers, and our level of retirees is about half of what Japan's is at this point. And our birth rate is still about, the 0 to 4 year olds is about 7%. So that's a very big difference. That 1%, 2% difference really has a major impact going forward. How about the United States on its own? Well, it's got some challenges. We've got almost as many producers as we've got consumers. Consumers are largely the millennial age group in the United States. So that's carrying our consumption. It's pushing our growth right now. The next group is smaller. The student group, the Zoomers, are smaller group, but they're still fairly close, at least compared to most countries that we've been looking at. They're fairly close in size to the millennial age group. And our retiree load is still not that bad, at just over 15%. Now, as part of NAFTA, we've got an economic zone where we can share manufacturing, consumption, we can sell into each other's markets. So we've got the opportunity to take advantage of Mexico's very strong demographics. Mexico has a large group of consumers and a much smaller group of producers. That's really good news for the US to sell into the Mexican market. It also gives us the opportunity to use Mexico's younger, less experienced workers so that we can manufacture and have a broad range of different skills and price points of labor for our manufacturing and other services. So Mexico is a very big asset for us in this perspective as part of the NAFTA group. Overall, this is going to have significant impact on exports. The demographics are going to put pressure on exports globally. That's part of the challenge we're facing, part of the reason we're seeing a change in the era, moving to a post-globalization era. The labor, as we see the aging out of these different countries' population, we're seeing labor shortages of younger workers, fast food restaurants. It's very easy to drive around and see help wanted signs in front of so many different restaurants and other places of work. So that's a challenge for us. and the supply chains continue to change. Since many countries don't have the same kind of workforce, they have other challenges they're dealing with as well. We're seeing major shifts in the manufacturing. We've seen that happen. It really got accelerated with COVID, but we're going to continue to see that for a number of years. With that, I'm going to hand it back to Steve to moderate questions.
Yeah, so any questions anyone has up front that they'd like to ask? We might want to kill the screen here.
Working on that here.
Okay, no worries. Yeah, sure. One question I have, Carl, is when I look at these demographics, you made the point that we're pretty strong in NAFTA. Mexico is extremely strong. We're not too bad in terms of demographics. But if these other countries, you mentioned Japan, and a lot of other parts in Europe are having challenges, then I would think that we're going to see, and that work starts coming to the United States, that's going to put more pressure on our labor than what you would see just in numbers alone. In other words, if you start seeing more reshoring of work, won't that create even more labor constraints in the future in the United States than what we might naturally project otherwise?
Right. So we've got several things that are putting pressure on the labor market, as you're pointing out. One is the change in the ratio of workers to the total population. That has been a number in the United States that's been very stable since the mid-'80s till about 2020. But that has now started to decline as the baby boomers are retiring and the smaller generation of Zoomers is coming into the workforce. So that's one factor. And then, like you pointed out, as the more manufacturing comes back to the United States, that increases the demand for labor. So we've got it both on the supply side and the demand side. So continued shortages, increased prices for labor seem to be the wave of the future.
Yeah. Anybody else got a question for Carl at this point?
Hi, Carl, Michelle, how are you doing?
Hey, Michelle.
Hi. My question is, the data that you captured are from 2020. How COVID affected certain range of population, especially the elder, and across the different countries and region that you were mentioning, could affect, in fact, some of these trends that you've seen. I know that it might not be so much visible, but still it has an impact.
Absolutely. COVID, I think, had a number of impacts. The 2020 data probably is too early to really see the full impact of what you're talking about. I think as we look at, data, for the US, we do the census every 10 years. So we'll have to use some shorter term estimates. And as they come out with a little bit of lag, I think we're just getting to the point where we're going to actually see how big of an impact that was. I mean, my understanding is the mortality rates are going to be higher for the older individuals on average. So yeah, it might thin out some of the ratios a little bit for the older groups. Be interesting to see how significant that impact is.
Yes. Any other questions? While we wait, I'll ask one. I got another one for you. I noticed that Mexico's, although their demographics are awesome, the one area that was a little weaker was that the 45 to 64 age group was pretty low, which means that and that's the capital creation. So as a percentage. So that would imply to me, maybe I'm mistaken, but it would imply to me that somebody would need, somebody from somewhere else has got to be putting some capital in Mexico. So I guess one risk factor I'm throwing out, hypothesis might be, is if things don't stabilize with the narco trade and violence, could that not kind of throw a monkey wrench in the whole equation in terms of the production capacity we expect and need in NAFTA and from Mexico?
So I'm hearing kind of two different points. I'm hearing that the capital constraints could be an issue for Mexico's continued growth of manufacturing, and the drug trafficking and the gangs related to that could also have an impact on Mexico. I think both
Yeah, and from a capital inflow, I was saying more from capital. Yes.
right. So worldwide, we're seeing the baby boom generation aging out there as they move past, on average in the US, and I think in most of the world, they're past 65 on average now. There's still some that are in their 60s, maybe even a few that are in their 50s, depending on how you define your baby boom age. As they get older and older, they're more and more likely to put their money into safer investments, more fixed income. And paradoxically, right now, interest rates are rising. So that also pulls more of that safe capital away from the riskier venture and private equity type of investments, even the stock market, into more fixed income, bonds and CDs and that type of stuff. What that means to me is that all the capital is going to be harder to get. And for North America, the US and Mexico in particular, if we're spending more investment money into manufacturing, that's going to suck it out of other areas of the economy. It's just substitution effect. So for Mexico, that's going to be, yes, a significant problem if, they don't have, because they don't have as big of the producer age group, which is where most of the capital formation happens in an economy. They won't be forming capital as fast as the US did in the last 25 years. So that's definitely a challenge. And risk is always a factor when capital's invested. So if the Mexican situation, the safety, the rule of law there is a concern, I'd absolutely expect that would push down the investment into the Mexican space. I think one of the questions is, from an investment space in Mexico, have we already pretty much used up the inexpensive labor in Mexico? So does it make more sense to continue to build out new manufacturing there? I think that's an interesting question.
We do have a question from Mark Clark. His point is, from a purely demographic and economic standpoint, no politics, what conclusions can you draw from the data about immigration policy in the US?
I think that's a really good question, really interesting question. Yes, staying away from the politics as much as possible on that issue, always a challenge. The obvious opportunity would be if you've got a situation like Ukraine, where you've got a lot of educated English-speaking workers that are being displaced, and the US is having challenges with workers. Wow, that would be an excellent opportunity to bring in workers on selective basis. Seems like a pretty straightforward, logical conclusion. The reality is that the politics of the United States are not ready to embrace that. Both the left, the right, I don't hear any calls for more immigration. And I think that's just the state of our politics. not of our economics. From an economic point of view, absolutely, we should be looking for opportunities to bring workers in. From a demographic point of view, I think that's a real challenge, though. Situations like Ukraine aside, most of Europe is aging out. They're looking to retain workers. The East Asia, Japan, Taiwan, Korea, certainly China, are having very significant challenges with young workers. So they have less reason to come to the US or to any other country for that matter. Typically, when you've got that population blend that's a pre-industrial type of demographic, when there's a lot of young people and they're looking for jobs and their own economy may not be fully employing them, giving them the opportunities they look for, that's when it's a lot easier to leave your country. And there are very few countries in the European, East Asian, North American, even South American space like that. And I think when you look at South Asia, India does not have, they're beginning to see in their younger age groups a shrinking. The birth rate's been coming down for the last 20 years there. So probably not that much coming out of India, even though it's a very large population. And I think Africa is just so different from a baseline assumption about how the world works and the very base level of education, that's an extremely difficult economic migration, maybe a refugee type migration, but from an economic migration, I think that's a really tough challenge.
Yeah. Hey, another question or point from Alan Ray was, I'm not hearing specific recommendations about market opportunities coming from these macro changes. So, Carl, can you address some of the opportunities that people may have as a result of these changes that you're seeing?
Excellent point. Excellent point. In the book, we go into much more detail in terms of how to identify specific opportunities for your company. But from a macro point of view today, let's talk about a couple things that come to mind. One of the big challenges as we're facing a decrease in the amount of capital available and a move broadly because of the demographics, move away from risk on type of investments to more risk reduced type of investments, that I believe that is going to indicate a very big change in the way that the stock market and investing in the public stock market is going to happen. I remember in the mid-90s, as the internet was taking off, everything seemed to be going up. And at that point, index investing became very popular, and it's been very successful all the way up till the last few years. We're now seeing what I see as the early stages of transition in the stock market, away from the tech stocks, away from some of the higher PE ratio type of investments. I still think there's going to be a lot of opportunities in the United States, but if you're using an index fund as a tool to invest, I think you're going to see some real challenges. I think you're going to see others go back to a methodology that's been very much out of favor for the last 25 years, and that's stock picking. So the changes that we're seeing are very specific. It's not the rising tide lifts all boats. We're seeing the opposite, where the tide come down. And so you're going to have to look at specific opportunities. Just as in the public markets, that also holds true for specific industries and within industries. So it's really hard to say that consumer goods are the place to be. Now, it's particularly from a demographic point of view, I think if you look at some of the other considerations that we're seeing in the economy, in terms of energy, and be one example, the fracking revolution has changed the way that natural gas is produced and the volumes it's produced. So that might make plastic production be much more economical in the United States because our cost of energy is so low. That's not really a purely demographic point of view. So again, I really, it would be easy to say that demographics is going to push all industries one way or another. I think healthcare is something with the aging baby boomers. That's going to be a lot more of everything in healthcare is likely to be in greater demand, memory care units to retirement homes to financial services for elders. I was talking to somebody the other day about creating photographic and musical and voiceovers to help people with memory issues. I think that's, that type of thing, all those types of things are going to continue to grow.
I think one of the questions was, if I'm running a business, what opportunities should I be thinking about for the business itself? In other words, you kind of hinted that we're probably going to be seeing more business coming, more manufacturing, more business coming back to NAFTA, in particular US, Mexico. What should I be thinking about as an opportunity for me to expand my business or grow profitability as a result of these changes?
Recently, I've been working with one company that's in a manufacturing type of environment, and they've been seeing a lot of impact upon their business. Steve and I will occasionally do a seminar workshop on optimizing manufacturing or complex product categories. And this is a situation I'm seeing with this particular company. So what's happening is their prices are changing of their inputs. They're seeing changes in the availability of certain types of raw materials. And what that's done is it's really messed up their production schedule. They're able to adapt and make do, but that's then had follow-on effects of impacting their pricing. So their margins in some products have decreased substantially, remain strong in others, but they're having to look at that much more closely and much more frequently than they have in the past. And so that's one area that you can keep an eye on, particularly if you've got some type of manufacturing type environment, or maybe even distribution where your prices are changing rapidly, and mix in labor force changes as well. That's just one more thing. So you've got to manage your resources more effectively with all these changes going on. And these changes are going to keep happening. It's not a once and done. This is going to be a number of years before we get through this and out to the other side. So that's one thing that I'd really look at.
Any other questions somebody might have? Oh, yes, hey.
Yes. Hey, Carl, you talked about manufacturing, but is the US ready to deploy capital? Do we have the labor, and I mean the skilled labor? And is there really a commitment, given the supply chain and the geopolitical issue, things going around, to really bring back manufacturing here, or are we just seeing at the surface? And again, given the pressure about sustainability and ESG and carbon and all the things we hear, I mean, are we really prepared?
Excellent question. I like, that's got several pieces to it. One is the commitment. Do we have the commitment? One of the things that I see is there's been a number of laws passed just over the last few years. This is a continuation of what we saw under the Trump administration, which was more about talk and tweets and exchanges with verbal exchanges with various countries that we need to bring manufacturing back to the US. We're continuing to see that over the last couple of years with domestic content requirements for automobiles, for microchips, for green technology. This seems to be a bipartisan commitment. So I very much see the commitment. I also see the need as we see more potential wars. We've got Ukraine going now. The Middle East is certainly a flashpoint. The Far East, we talk about Taiwan. There's many other potential conflicts in that region. So there's a lot of other reasons why supply chains could be disrupted. And I think large companies, even small companies, but the large companies that have moved their supply chain so much overseas, Apple's an excellent example of this. I've heard at some point Apple had like 100,000 workers in China producing iPhones. With the recent ruling on tech manufacturing, the US has essentially said, we are withdrawing our tech for chip manufacturing. We're no longer allowing the products, the raw materials, the equipment to be used in China. And even the labor, we said, you've got a choice. You can keep working in China, or you can lose your citizenship, or you can leave that industry. So there seems to be a lot of commitment. And there's several other reasons why this is likely to happen. Now, then the next question is resources. Do we have the labor to do it? And labor is going to be a challenge. I saw wire coat hangers. Before the pandemic, the vast majority of wire coat hangers were made in China. It's a very low cost item to manufacture. There's a lot of grabbing and putting in boxes and manual tasks the way it's traditionally been done. With the pandemic, there was a huge shortage. Very quickly, 3 different companies in the United States ramped up with pretty automated systems. They still use people in many roles in their companies, but they automated, and now a much larger percentage of that activity, that product, is made in the United States. So I do think we're going to have to use automation as best as we can. There's always limits to automation, but we use automation as much as we can. And I think that will then put pressure on other industries like fast food that's used a lot of labor. You're going to see, I read about a McDonald's location where there's no human-facing customer interaction. There's some people behind the scenes running the restaurant, but you order through pads or apps, and the food is delivered through portals and boxes, and you don't actually talk to a human being. You don't see any human beings. So they're being more effective with labor. It's not robotics, but it's some form of automation. I think we're just going to see more and more of that type of activity, which is going to allow us to, I think markets will adapt. And the final point is that it's going to cost more. That's a big part of the inflation we're seeing. It's, money supply aside, whatever happens to the money supply, the fact is it's less efficient to do this manufacturing in North America. It's more reliable. It puts things in our control. It means we're less vulnerable to supply disruptions, to military and political interference. But it is going to cost more to make those wire coat hangers. It is going to cost more to do a lot of things in the United States.
Carl, I have a question from Alan again. Here's a good question. This is a very interesting one. Interesting how you label young adults as primary consumers in the economy. That can be true in absolute rank, but the growing senior population's consumption of specific services that are quite expensive is rather substantial, and there is a painful labor shortage to serve them. So in other words, what can we expect in the next 10 to 20 years in caring for the elderly? Because, you know, we were talking about automation. You were talking some levels of automation a second ago. You wonder, though, what can be done with what they do for the seniors? That would be the question. Your thoughts on that?
Right. Yeah, there's certain specific things, as the question states. There's specific things that the baby boomers who are now becoming the seniors, the retirees, if you will, are going to consume. So it's really hard to automate moving somebody, in and out of a hospital bed or a retirement home bed or those type of things. So absolutely, there will be specific services that are going to be in very high demand. Staffing a memory care unit, very hard to automate.
When you think that's going to drive up the cost of those services? I mean, that's going to be the natural reaction to that, right?
Well, you've got two sides to that. Absolutely, the cost goes up, but typically when cost goes up, demand goes down. I think you're going to find, because of cost restraints, not every baby boomer is saved up, a hoard of gold to take care of themselves in first class style. I think you're going to see more economizing in some of those services. Doesn't mean they're going to go away, but innovative entrepreneurs tend to find innovative solutions when there's a mismatch between price, demand and supply and demand. If demand goes up and supply can't keep up, price goes up and entrepreneurs flock in. That's the basic concept Adam Smith and America's built on. We've got a lot of government regulations and government involved, and I think that's reasonable because we're not a perfect capitalist society, but still I really expect that we're going to see some innovative solutions in that space, some economizing in that space, and some continued pressure on price. That's going to continue to drive up labor. That's going to impact manufacturing. It's going to impact retail, all different, services, all different parts of our economy, and it will continue to drive inflation.
Yeah. And hey, did you have another question? I'm sorry. Yeah, your thing's still on, so I was asking.
No.
Okay, no problem. Just want to make sure. Another thought is, with this work coming back in theory to the United States and Mexico, that in itself represents opportunity, right? Because that means U.S. firms or U.S. manufacturers are going to be getting more, have the opportunity to supply more volume because they're taking a bigger share of the world volume and supply. So I think, there was a question about opportunity. I think that's going to clearly be an opportunity. And then as supply chains have problems, I think another aspect is going to be if people have a domestic supply chain or decide to take an inventory position, there is an opportunity to lead time based pricing, which could probably give you some upside as well. So I think there's going to be natural things there. So anyway, just something to think about. Roland has a question. Roland, please ask your question.
Sure, thanks. Very interesting, Carl. If I kind of follow the logic, we're going to see slower overall growth. I think some of the, without getting into the full politics, but you could expect an increase in some protectionism across some of these countries. So just like the stock picking argument in terms of higher returns, seems to me that you might want to look at your own customer portfolio in the same way. You're not going to get growth through the natural tide. You're going to have to get growth by competing better within your pie, within your slice of the pie, right? So increased understanding of where you're competitive, how you're pricing for value, all those things are going to be much more important because you can't take advantage of that overall tide, as you're saying. Is that fair?
Yeah, very well said, Roland. The impact of management when capital's cheap, growth is solid, labor's available, the value of management in that scenario is relatively low. And that's the way things have been over the last 25 years. What we're seeing going forward is that capital is more expensive, labor's in short supply, the value of management, the value of doing the type of analysis you're talking about, and many others, is much higher. And so your return on excellent management is higher. So investing in management techniques, investing in tools that help you more effectively identify opportunities is absolutely, parallel to the stock picking, like you mentioned. I would agree.
Like that analogy of almost thinking in terms of what the index funds was to your overall investment portfolio, your management team was to your business portfolio, and now you've got to find a more discerning set of capabilities, tools, leadership, whatever.
Yeah. And when you think also, we're talking about labor here, which is going to be much more constrained, I believe, going forward. And that takes but all these areas, whether it be less capital, all those things are taking slop out of the system, and so therefore you have to have more precision in everything, right? I mean, that's going to be the nature of this, right? We have to be better at everything we do.
Yeah, I see
Alan had another comment I think was interesting. He said, while the value of management has been low in recent decades, just as the executive class found so many ways to increase compensation independently of them owning much of the companies. I think, Alan, that's a very, very good point. The thing is you've heard the phrase about a rising tide lifts all boats. So in other words, when everything is wonderful, everybody gets better and everybody just naturally assumes it must be them leading the way. It's their leadership. And of course, when it goes the other way, they say, well, how could I have done anything? And so I still need the big payout. So that's a very interesting perspective.
very true. Very true.
Any other questions?
Well, while we're thinking of one more question, I think we'll have time for one more question, but a reminder, 4 weeks from now, March 30th, we're going to have another discussion. It'll be a little bit more broad. This one's been more focused on the demographics. That's the release date of the book Surfing Economic Chaos. And so we'll also have some door prizes as well for that event. So look forward to seeing you all there. See if we've got one more question, thought, idea.
Well, one thing I will add is I do believe, while we wait for that last question, I do believe that how you think about talent management is going to become more important than you've ever known before as you go forward. So the old and tried formulas probably will not work well. So you need to be thinking innovatively about why people want to work for you. How do you attract the best talent, develop them, grow them, and try to hold on to them? I think that's going to be a key challenge. And I think the other trend I think you're going to see is small companies are going to use more and more fractional resources because that's going to be required for them to be more effective and so forth.
Completely agree, completely agree. You know, labor shortages, we're already seeing them. If you look at the demographic trends, I've got a chart in the book that I think makes a very central point. It's continuing to decline in terms of the labor supply in the United States. It's not unique to the United States. This is a continued challenge, and workforce management, motivating people is fundamental to running any business. So, very good.
Okay. Any last question anybody has?
Thank you.
We appreciate all of you. Yeah, thank you. Roland, you have one more question? Or just say bye-bye? Okay. Just ready.
There you go.
All right.
That was applause.
Oh, thank you. Well, I think Carl did an excellent job. Yeah, absolutely. Okay, well, thank y'all for coming, and we look forward to seeing you at the launch party. I believe that date was on March 30th. It is on the internet, so it is out there on LinkedIn. And if you've got an interest and want to reach out, we can connect you to it. So that's no problem. Here it comes.
If you have any questions, reach out to Steve or myself.